All right, let's talk about Alliance Laundry Holdings. They just had their first earnings report as a public company, and it was a real head-scratcher. They absolutely crushed expectations, but the stock got crushed. So why? That's exactly what we're going to figure out today. Here's how we're going to break it all down. First, we'll look at the results and that bizarre stock drop. Then, we'll dig into the super bullish story management is telling and contrast that with why the market is so skeptical. We'll pinpoint the exact reason for the sell-off, and then I'll give you our final take, our rating, and what we think happens next. Okay, let's dive right into the numbers. Because, on the surface, this looked like a picture-perfect debut quarter for a brand new public company. So let's start with the bottom line. Alliance reported adjusted earnings of 28 cents per share. The Wall Street consensus was sitting at 22 cents. That's a massive 27% beat. Right out of the gate, that's a fantastic number. And it wasn't just the bottom line, the top line looked just as good. Revenue came in at over $437 million, which is up a very strong 14% from last year. And yep, that beat expectations too. So you've got a double beat. What's not to love, right? Well, this is where it gets weird. Look at the market's reaction. The stock opens up almost 3% on all that great news, but then the sellers just took over. It was a slow bleed all day long, and the stock actually closed down almost 5%. A complete reversal. So this is the central mystery we have to solve. Why the huge disconnect? What did the market see or hear that made them completely ignore such a strong earnings report? To understand why the stock dropped, you first have to understand the story management was telling on the earnings call, and let me tell you, they painted a very, very rosy picture. The CEO, Mike Schoeb, really set the tone here. He positioned the company not as some boring appliance manufacturer, but as an essential, resilient service. He even had this great line on the call where he said that whenever there's turmoil in the world, his team just looks at each other and says, "Thank God for laundry." It's a compelling story. So they laid out this really powerful four-part case. They said, look, we're the undisputed market leader. We're executing flawlessly with double-digit growth. We're using the IPO money to pay down debt, and we've got new products coming. On paper, that sounds like a fantastic investment. But, and this is a big but, despite that confident narrative from the C-suite, the market just wasn't buying it. Investors were looking right past that great quarter and focusing on something else entirely. And this slide right here, this is the whole conflict in a nutshell. On one side, you have management pitching a high-growth, deleveraging success story. But on the other side, you have what investors really saw, a classic private equity-backed IPO with a lot of debt still on the books, and, most importantly, a growth slowdown that was hiding in plain sight. The full story really started to spill out during the Q&A session with the analysts. And, it's always telling what they ask about. They weren't congratulating the team on the great quarter. No, they were laser-focused on the future. And that's where things got tricky. First topic, debt. Now, paying down debt is absolutely the right move, but starting out with a net leverage ratio of 3.1 times, that's still pretty high. The fact that analysts were really pushing for a timeline to get that number lower tells you the market is still a bit nervous about the balance sheet. But okay, if you're looking for the smoking gun, this is it. This is the slide that explains everything. After putting up that awesome 14% revenue growth, management guided for Q4 growth to slow dramatically, down to just mid-single digits. For a brand new growth stock, that is a huge red flag. Now, management had an explanation, of course. They said, hey, we're just getting back to a more normal growth rate after 2 incredible years. And that's fair. But all the market heard was, the party's over. The explosive growth is gone. So you've got this battle, right? A fantastic quarter in the rearview mirror versus some pretty big fears about the road ahead. So let's weigh all the evidence and make our call on the stock. So here at Talk Tickers, we are initiating our coverage on Alliance Laundry with a market perform rating. Now, let's be clear about what that means. We're expecting the stock to basically tread water with the rest of the market over the next year. We think the risk and the reward are pretty well balanced right where it is. So what happens from here? Well, here's our 3-part prediction for the next quarter. 1, we think they'll probably meet or even slightly beat their own conservative guidance. 2, we expect the stock to be pretty much stuck in a range, not crashing, but not soaring either, at least until we get a full-year outlook for 2026. And 3, the only things that will matter are paying down debt and protecting their margins. If you're watching this stock, here are the things you need to have on your radar. Any progress getting that debt number down, holding margin steady, and especially that formal 2026 guidance, any of those could be a real catalyst to move the stock. So here's the bottom line. Alliance is a good, well-run company. Nobody is really questioning that. But after that guidance, it has officially become a show-me story. The market has priced in the good execution, but now it needs proof that the growth story isn't over. And as always, please remember, this analysis is for informational purposes only. It is not financial advice.